Hello everyone, I'm Sahil and welcome back. With this video, I'm adding yet another segment to our channel. In this segment, I will give you guys my analysis of the various company I have personally invested in. So for today's video, we are starting off with my favorite company, China Water Affairs Group. We shall first cover the industry background real quick and I'll talk a little bit about the various players in the market. Moving on to the company overview where I'll tell you briefly what the company is all about, and then I'll talk about my investment thesis, and in the end I will give you my valuation, the fair value of the company. So let's hit it up. Rapid economic development has had a major impact on the demand of water in China. As the economy changed over 1990s, substantial investment became necessary in water, wastewater treatment facilities and other component of the water sector. In the past, the domestic water supply was provided by the public sector. However, the funds and technology of the local government was limited and investments were insufficient. All this hindered the water supply development, resulting in low production efficiency and bad service. As a solution, initially the government came up with a public-private partnership, but since then they have been pushing for full privatization of the industry. The water supply chain in China can be broken down into three major stages: raw water distribution, tap water supply, and wastewater treatment. Upstream raw water distribution mainly involves the transportation of raw water from natural water sources to downstream water treatment plants, and in some cases preservation projects such as reservoir construction. Tap water operators treat raw water and supply it to the end users through their pipeline network. As stipulated by the regulations, the water supplier is also responsible for installation of water meters to measure water usage and collect bills from the customers. Finally, the sewage produced by the end user is collected through a sewage network and is treated before it is released into the seawater. So these are the various players in each segment of the entire value chain. There are other private and state-owned companies as well, but I have not included them since I have no information on them. As you can see here, I have arranged them according to the revenue they have in each particular segment. China Water Affairs Group is the biggest player in the water supply segment, and Beijing Enterprise Group is the biggest in the wastewater treatment. There are these two international companies as well, but I can't find the revenue from each segment. So the 9 billion you see here is the total revenue from China for the company. So let's focus on China Water Affairs Group in particular now. China Water Affairs Group, or CWA in short, is an investment holding company headquartered in Hong Kong with management centers in Beijing and Shenzhen. It is currently traded on the Hong Kong Stock Exchange under the ticker symbol of 0855. And it is the only Hong Kong listed Chinese company that has a focus on tap water supply. By investing, building and operating water affair projects in China, the company has rapidly built its reputation as one of the largest integrated water operators. Today, the company's business spans over 110 cities in mainland China. It is vertically integrated across the entire water value chain. However, as I mentioned earlier, it mainly engages in the tap water supply and wastewater treatment business. CWA operates the water supply business of over 60 cities, and as a business point of view, this segment generates stable and growing net cash, which is largely immune to the economic cycle. As of 6 months ending September 2020, the water supply business represents 82.6% of the company's revenue and 88.3% of the company's net profit. So this means that the bulk of the company's business is in tap water supply. Also, the company's water pipeline span over 150,000 kilometers, which serves 30 million people. The environmental protection business, which provides sewage treatment and drainage operations, represent 9.7% of the total revenue and 7.2% of the net profits. Most of the CWA's project adopt the transfer, own and operate model, TOO for short. In this model, the company invests in the acquisition of the completed water supply projects and undertake the operation, maintenance and expansion of these projects. There are these other types of models as well. If you'd like to read up on them, just pause the video. If not, let's move on to the financials of the company and see where it stands. In terms of revenue, CWA has seen a growth of 83.4% in the past 5 years, and analysts expect it to grow another 40% in the next 3 years. This is some serious growth and not something you usually see from a utility company. The gross profit margins have seen a slight decrease in the past few years, which means that the supply of water is costing a bit more. However, the net income margins have increased steadily, which is an awesome sign. With increase in revenue and the net income margin, it's not a surprise that the earnings have been increasing steadily as well. Moving on to the cash flow statement, the increase in operating cash flow is actually a better sign in my opinion than increase in earnings, because the earnings can be inflated in the short term with activities such as sale of assets and other things. The cash flow from operating activities filters out any such gain. CWA is generating a healthy amount of cash from its operating activities, and it has been increasing steadily. So this cash can be used to invest in the company's expansion or to pay me dividends. CWA's free cash flows has some issue. Free cash flow at its basic is the amount of cash generated by the business minus any investments it makes to maintain or to expand. These investments can come in two forms. Firstly, fixed assets, assets such as factories, machines, and so on. And secondly, intangible assets, which are like patents, concessions, and so on. Since we have already established that the operating cash flow is great, so the problem must be with the expenses. The capex is quite low, so that is not a problem, but the purchase of intangible assets is consistently very high. Now the question stands, what are they actually buying? Well, the water supply business is regulated by the government, and in order to expand into new cities or projects, CWA must buy concessions for these projects, and these concessions are seen as an intangible asset. To fund this buying of concessions and the fast expansion, the company opts to take loans, and this has resulted into high debt with a gearing ratio of 66.4%. In regular companies, it would be a big problem, but for regulated companies, it's not. Let me elaborate. CWA uses these loans to buy concessions, which we already know. These concessions gives the company a monopoly in an area for 25 to 30 years. That means that no competition, hence it's very safe. But in addition to this, the government also offers guaranteed returns on these projects. In China, this ranges from 8 to 12%, and if the profits are dropping below this level, the government will give the company money in terms of subsidies, or it will increase the water prices. Now, if you can take loans at interest rate which is below these guaranteed level of returns, what you are actually doing is just keeping the difference in your pocket, which is an awesome deal. Since the lenders know that the business is very safe, they are willing to lend at a lower interest rate. The effective interest rate for CWA in 2020 was 2.16%. What this means is that if they expand solely based on loans and they are able to get a returns, the lower side of the returns at 8%, they are still keeping 5.5 to 6% of the entire investment after paying off their lenders. And this is amazing. They can expand as much as they want and they still won't be crushed by the debt. Since we're already here, let's look at the dividend as well. So CWA paid a dividend of 31 Hong Kong cents in the past 1 year, which equates to 5.1% dividend yield. The payout ratio stood at 29%, which is very low for a utility company. So there's a lot of room for them to grow the dividend, even if the business stays same. Now let's look at the two investment theses I have. Firstly, the water scarcity problem that China faces, and secondly, the high growth potential of the company. China is home to 21% of the world's population. However, it only has 7% of the world's freshwater supply. Particularly in the north, the country is deeply parched. So much so that in order to conserve water, the government said it will encourage people to eat potato instead of the water-intensive staples such as rice and wheat. The analyst report suggests that the market is focusing its money on wastewater treatment as a solution. However, I believe that the uneven distribution of water is a far easier solution, and the market is not pricing that in at all. China's overall water resources are pretty reasonable. They stand at 2000 cubic meter per person. This is above 1700 cubic meter where the water stress starts, and well above the 500 cubic meter of water scarcity. But the issue is that 80% of this water is concentrated at the southern part of China. That means that 8 provinces in the north suffer from acute water scarcity, 4 from water scarcity, and 2 are largely desert. These 12 provinces together account for 38% of China's agriculture, 46% of its industries, 41% of its population, and 50% of its power generation. Coal and nuclear uses a lot of water. The government is already working to solve this issue with its south to north water transfer project, and this project is really good for CWA. For example, once the project is completed up to Henan, CWA has an immediate expansion plan with a capacity of 100,000 tons a day to use this water from the project. Now moving on to the second thesis, China's tap water supply remains largely state-owned with only 20% privatized, and with the government's push to privatize the entire industry, it's safe to say that there's an upside of 5 times if all else stays equal. CWA, being a holding company, relies on acquisition of new city contracts and companies in order to grow. This is on top of the organic volume growth that comes from the existing contracts, which is driven by the growing economy. At the moment, the company plans to acquire 10 to 12 cities every year with a focus on tier 2 and tier 3 cities. The urbanization and industrialization trends in these cities are very strong, which further boosts the organic growth. Even with such growth opportunity, the share price of the company is at a great discount. So let's try to figure out what is the fair value for CWA. To value a company, there are many different ways, but today we will be using the dividend discount model. For that, we need to know 3 things: the current dividend, the expected growth rate, and the required rate of return. The current dividend we already know is at 31 cents. The expected growth rate, which if we take the next 3 years projected earnings growth rate, will be at an average of 9%. If we take the past 3 years dividend growth rate, it will be an average of 11.3%. The past year's growth rate is 7%. Since that's the lowest, let's just take that. For the required rate of returns, I'm just using the sum of risk-free rate and equity risk premium. According to this model, the fair value is at $10.6 a share. And since the current price of the share is at $6.80, that means there is a potential upside of 75% if we are expecting a return of nearly 11% every year. I also have this very interesting comparables table for you guys to see. It clearly shows how overpriced the US market is when compared to China. Okay, that's about it for today's video. I would like to highlight that you should do your own due diligence before making any investment decision. Don't trust people like me on YouTube with your hard-earned money. Invest safe, and until the next video, ciao.